I'm Kenny Gott, Certified Financial Planner Consultant and President at Pycheck & Associates in Springfield, Missouri. Let's set the record straight on the pros and cons of annuities and the four types. I go into more detail in my book, Bottom Line Financial Planning, Manage Risk and Fund the Good Life Your Whole Life. We'll give you a free copy when you meet with us, and if you like, we'll analyze your investments, whether or not you have annuities, and give you a complimentary professional second opinion. We're securities licensed and insurance licensed, which sets us apart from most advisors who are just one or the other, so we can offer the full range of investments, including securities like stocks and bonds, as well as insurance products like annuities. At the end, I'll talk about some annuity hazards, but let's start with an overview of the original annuity that's been around since Roman times, the immediate annuity. With this annuity, you give an insurance company some money, and they turn it into a monthly income, but you give up your principal, so there's no account value, it's income only, but it's guaranteed income like a pension. Now, the amount of income depends on your age and how long you want the income to continue. It could be from 5 to 10 years up to lifetime income, so let's say you turn on the lifetime income. If you die the next day, the income stops, you lost the bet, there's nothing for your heirs. If you live longer than average, the income continues, so you may beat the insurance company at their own game. So it's a gamble on your lifespan. There are versions that'll continue the income to a beneficiary for a certain period of time, but generally this product is less popular than newer versions that don't make you give up your principal. So let's look at those, starting with the fixed annuity. It's a set interest rate for a period of time, usually 3 to 10 years, so it's like a CD, paying yearly interest, and in general, they beat CD rates. In exchange for giving you a better interest rate, a fixed annuity has limited liquidity for a period of time. You may be able to withdraw interest earned or up to 10% of the account each year, depending on the contract, but beyond that, you pay a stiff penalty. So if you have plenty of other available assets, this annuity may be good for part of your money. There are no fees and no optional guaranteed income features, and like all annuities, they're tax deferred. This doesn't matter in an IRA account, which is already tax deferred, but in a taxable account where you normally pay tax each year on the interest, in a CD or savings account, for example, here you don't pay any tax until you pull money out. At that point, it's ordinary income tax on the growth. That may be a higher rate than capital gains tax, so just be aware of that. Now, since it's not a bank product, a fixed annuity isn't guaranteed by the FDIC. Instead, annuity contracts are protected against default by state guarantee associations up to $250,000 as of now. And all annuities are backed by huge insurance companies, so if your advisor uses highly rated companies, it provides good safety for your money and usually a decent interest rate if you shop around. Next is the equity indexed annuity. Your interest earnings are based on the growth of a stock index like the S&P 500, for example, but you're not directly in the stock market at all. Instead, each year on your contract anniversary, if the stock market is up, you earn interest up to a certain limit, but if the stock market drops, you don't lose money, you just get zero interest that year. There are various formulas and indexes, and some are complicated. We prefer simple ones, where, for example, you may get whatever the S&P 500 does up to a limit or cap, or some give you a certain percentage of the S&P with no limit. So those are pretty simple and generally get more average growth per year than fixed annuities, but there's more variation from year to year. And again, like all annuities, it's tax deferred, which again can be good for a non-IRA account. It has limited access to the money for a period of time, and generally, the longer that is, the better the terms. Just make sure you have plenty of other resources during that time. Now, there are no fees unless you choose to add an optional income rider, which may cost around 1% per year. Now, the income rider is a separate formula that gives you a guaranteed lifetime income, either starting from the beginning or starting later on. That money does come out of the account, so this will affect the account value depending on how much growth you're getting. But we've found for most clients an income rider isn't worth it because the rider fee hurts your growth potential, and we can usually do as well or better by simply taking withdrawals from a moderate brokerage account or from an annuity without the rider fees. We can talk about the pros and cons for your own situation when you meet with us. And like the fixed annuity, it's backed by state guarantee associations and large insurance companies. So again, make sure your advisor uses highly rated companies like we do. Now, we've used fixed and indexed annuities for a lot of conservative investors, and when rates are pretty good, sometimes we'll use them as a bond substitute for moderate investors because it may grow as well or better than bond funds, and with no fees on the basic version, it can actually increase growth potential while cutting overall expenses in a portfolio. Okay, the fourth and final type of annuity is the variable annuity. This is the one that's given annuities a bad reputation in the past. First, it's invested in stock and bond funds, so your account value can have big swings up and down, just like the stock market, if you're invested aggressively. And you're charged investment fees for those holdings, typically around 1 to 2% per year. In addition to investment fees, there's usually a 1 to 1.5% fee just to own the thing. You can also buy an optional income rider and or a death benefit rider, again with a fee. So without any riders, you're looking at 2 to 3% total fees, and with riders, it can be over 3%. We've come to believe, because of the fees, a variable annuity is usually not appropriate for most investors unless it has a really good income or death benefit rider and you're an aggressive investor who doesn't mind stock market volatility. So if an advisor recommends a variable annuity without an income rider, let us give you a second opinion. Even with a rider, there may be better alternatives. It depends on the situation. Just proceed carefully and let us take a look. And again, like all annuities, a variable annuity is tax deferred, a potential advantage for non-IRA accounts where you'll pay ordinary income tax on just the growth when you pull money out. Most have limited liquidity for a period of time, and they're backed by huge insurance companies, and this is very important. The state guarantee associations will give you the same protection as other annuities for losses due to an insurance company default, but not for stock and bond market losses. The stock and bond holdings in there are not protected from market ups and downs. So are annuities too complicated? Well, some are complicated. Let me show you the notes I took when a variable annuity wholesaler explained their income rider in our office. Now, I wrote my book largely because clients tell us we're good at explaining things. So if the best rider for the situation is this complicated, we'll take the time to help a client understand it one little bite at a time. It can be done, but most annuity riders are not this complicated, and usually the best one is also pretty simple these days. So don't let this scare you away necessarily. Keep an open mind, but we'll try to build an income strategy for you that doesn't require a diagram on a flip chart. Now that leads me to potential annuity pitfalls, starting with this. If you don't understand what someone's trying to sell you, don't buy it. That applies to everything, not just annuities. There are always alternatives. The front-end bonus is a popular selling point for some annuities, up to a 10% bonus on your deposit. The problem is insurance companies can't afford to give you the bonus along with the same terms they give non-bonus annuities. So what happens is the insurance company gets back the bonus they gave you by giving you less favorable ongoing terms, like lower interest caps, for example. And from then on, you're getting that lower rate of growth. So after a few years, you would have been better off with the non-bonus version. Once again, check the ratings on any insurance company issuing an annuity. And one more time, income riders sound good, so salespeople sell them, but you may be able to generate just as much investment income by other means. And if a rider kicks out more income than you actually need, especially from an IRA, you may be needlessly costing yourself more taxes. And a rider fee goes against your growth potential, so don't let someone sell you the rider if you don't need it. Here's our number. Call for your complimentary consultation. We'll give you a professional second opinion on your investments, see how cost efficient they are, how tax efficient, your risk level, your performance, see if we can help you do better. And maybe you need a retirement analysis to see how much growth you need to enjoy a long retirement and what kind of investment mix will get you there. And we can use our recession reserve approach to help you worry less about the stock market or not at all. So you can focus on living the good life. If you're not 100% happy with your current advisor, call us. Remember, it's your future. You earned it. Thanks for watching.